Every major economic crisis in history shares a strikingly similar pattern, yet we continue to ignore the warning signs. In 1929, the U.S. stock market collapsed, wiping out $30 billion in wealth, equivalent to over $500 billion today. What caused it wasn't greed alone, it was a systematic failure embedded in the financial system. Consider this. In 2008, the world lost over $10 trillion in household wealth in less than a year. Governments printed money, banks collapsed, and yet few connected the dots to the same mechanisms that triggered the Great Depression. History has a rhythm, and it repeats when lessons go unlearned. The pattern, economic framework. Economies operate in cycles of credit expansion and contraction. Banks lend money they do not fully possess, creating artificial growth. This credit stimulates spending and investment, inflating asset prices beyond their true value. When debt grows faster than income, a tipping point occurs. Borrowers struggle to service loans, defaults rise, and banks face insolvency. The chain reaction triggers a contraction. The same pattern appears in nearly every financial collapse. Governments exacerbate these cycles through monetary policy. By lowering interest rates, central banks encourage borrowing, boosting short-term growth. Yet, prolonged low rates can seed long-term instability, a lesson evident from both Weimar Germany and modern economies. Inflation acts as a silent predator in this cycle. As debt accumulates, governments often print money to meet obligations. Prices rise, purchasing power falls, and the population bears the hidden cost of fiscal mismanagement. Historical case study. Let's examine the Weimar Republic in Germany, 1921 to 1923. After World War I, Germany owed reparations exceeding 132 billion gold marks. To meet these obligations, the Reichsbank printed money, triggering hyperinflation. By November 1923, a loaf of bread cost 200 billion marks. Savings evaporated, wages became meaningless, and social unrest erupted. This wasn't an isolated incident, it was a textbook example of debt-driven currency collapse. Similarly, in the United States during the 1920s, excessive credit expansion led to the 1929 stock market crash. Margin lending allowed investors to borrow up to 90% of stock prices, inflating asset bubbles far beyond underlying economic productivity. Banks, heavily leveraged and poorly regulated, collapsed when borrowers defaulted. The Federal Reserve's delayed intervention worsened the crisis, proving that monetary mismanagement amplifies systemic risk. Unemployment soared to 25%, leaving millions destitute. Moving forward to the 1980s, Latin America faced a sovereign debt crisis. Countries like Mexico and Argentina borrowed heavily in dollars during low interest periods. When interest rates rose, debt servicing became impossible, leading to defaults and economic stagnation. The IMF intervened with conditional lending, demanding austerity measures that further depressed local economies. Inflation skyrocketed, social unrest intensified, and the cycle of debt and collapse repeated, echoing patterns from previous decades. Another critical case is Japan in the 1990s. After rapid asset inflation in the 1980s, the bursting of real estate and stock bubbles led to a prolonged economic stagnation. The Bank of Japan's low interest rates and government stimulus programs failed to restore sustainable growth. Here, credit expansion, asset bubbles, and monetary policy missteps converged. Debt remained high, growth stagnated, and deflationary pressures persisted for decades, demonstrating that even developed economies are vulnerable to these patterns. Modern application, right where we are now. Today, global debt exceeds 300 trillion, surpassing 350% of world GDP. Central banks, including the Federal Reserve, European Central Bank, and Bank of Japan, maintain historically low interest rates, fostering unprecedented credit expansion. Sovereign debt is no longer a problem confined to emerging markets. Italy, the United States, and Japan carry unsustainable debt loads, with deficits financed by continuous bond issuance. The risk of default, though politically sensitive, is a structural reality. Inflation, often dismissed as temporary, mirrors early warning signs from historical collapses. Core prices in many economies are rising faster than wage growth, eroding household purchasing power. Governments may attempt to mitigate this with monetary intervention, but the underlying debt cycle remains. Asset bubbles are evident in real estate, stock markets, and cryptocurrencies. Housing in major cities has appreciated far beyond income growth, echoing the margin-fueled stock speculation of 1929. The risk is not just market volatility, it is systemic vulnerability. Central banks have become the de facto backstop, yet their tools are limited. Negative interest rates and quantitative easing may stabilize markets temporarily, but cannot resolve the structural debt imbalance. History suggests that the ultimate resolution may require a correction far larger than anticipated. Currency devaluation remains a looming threat. The US dollar, as the global reserve currency, has facilitated massive international borrowing. Any loss of confidence could trigger a rapid shift in global capital flows, reminiscent of past reserve currency transitions from the British pound to the dollar. Governments often underestimate the lag between policy action and economic impact. Stimulus spending can boost growth short term, but inflates debt over the long term. When tightening measures eventually arrive, the shock to markets and populations can be severe. The implications? What comes next? If current debt trajectories persist, a debt crisis could trigger cascading failures across banking systems. Insolvent institutions, paired with overleveraged governments, may be forced to restructure or default, destabilizing global financial networks. Inflationary pressures could accelerate if monetary expansion continues unchecked. Consumers will experience diminished purchasing power, and social inequalities may widen, echoing the societal consequences seen in historical collapses. Asset markets may enter prolonged downturns. Real estate, equities, and alternative assets could correct sharply, wiping out paper wealth accumulated over decades. This correction is not a distant possibility. It is a historical inevitability if the pattern remains unchecked. Sovereign debt crises may shift global power dynamics. Countries reliant on foreign borrowing could face political instability, while reserve currency nations might lose leverage. The redistribution of economic influence could reshape trade, investment, and geopolitical alliances. Policy errors are compounding risk. Governments often respond to early warning signals with short-term fixes rather than structural reforms. The result is a widening gap between financial markets and real economic stability. Banking systems remain fragile. Excess leverage, opaque derivative exposures, and interconnected global institutions amplify risk. A localized crisis could quickly escalate, impacting economies worldwide. Credit expansion, when combined with low interest rates and high leverage, remains the central mechanism of modern economic instability. Recognizing this pattern is crucial for policymakers, investors, and citizens alike. Historical precedents illustrate a clear sequence: excessive debt, speculative asset growth, monetary expansion, inflation, and eventual correction. Ignoring these signs does not prevent the collapse. It merely delays it. Modern financial instruments may mask risk, but they do not eliminate it. Securitized debt, derivatives, and digital assets create complexity, making the collapse more difficult to foresee, but not less inevitable if underlying imbalances persist. Conclusion: the contrarian insight. The economy is not a mysterious force controlled by external factors. It is a predictable system of human behavior, debt, and policy choices. Recognizing the patterns of history allows us to anticipate risks rather than react in panic. Understanding credit cycles, monetary policy failures, and debt-driven crises reframes the way we view economic news. Market booms and busts are not anomalies. They are symptoms of a deeper systemic rhythm. The contrarian insight is simple. Economic stability is an illusion when built on unsustainable debt. Only by addressing structural imbalances, limiting excessive credit expansion, and respecting the lessons of history can long-term resilience be achieved. As we navigate the modern financial landscape, the stakes are higher than ever. Global interconnectedness magnifies risk, and the consequences of ignoring these patterns could be profound. Yet, knowledge and vigilance remain our best tools against the next inevitable collapse. History teaches a final warning. Patterns repeat, often with greater intensity. Recognizing the rhythm of debt, credit, and policy missteps is not fear-mongering, it is preparation. In understanding the true mechanics of the economy, we gain power over its cycles and perhaps a chance to mitigate the worst outcomes. The economy does not operate on luck or chance. It operates on predictable human behavior amplified by policy choices. By studying past collapses, we see not just what happened, but what is likely to happen next. Knowledge of these patterns is both a warning and a guide. The lesson is clear. Sustainable growth requires restraint, foresight, and structural soundness. Short-term fixes may soothe markets, but they do not prevent the eventual reckoning that history has proven inevitable. In every collapse, the same elements converge: debt, overleverage, speculative bubbles, monetary mismanagement, and delayed policy response. Understanding this sequence provides a roadmap for recognizing danger before it becomes catastrophe. Modern economies are complex, but they are not immune. The historical patterns of Weimar Germany, the Great Depression, Latin American debt crises, and Japan's lost decade echo loudly in today's global financial system. The economy, in essence, is a mirror of human decisions. Debt grows, confidence fluctuates, and policies react. Recognizing the underlying structure allows us to anticipate, adapt, and possibly prevent the most destructive consequences. This is not a call to panic, but a call to awareness. By understanding how the economy really works, we move from passive observers to informed